So first, the obvious disclaimer. Obviously, this is not financial advice or otherwise advice. Seek your own counsel if you're interested in making investments in the space. These are the topics we're going to address, just so you know what's coming up. So first, we focus on Bitcoin and blockchain basics, and there's a lot of misinformation in the space, so we walked you through some of the most common ones. We talk a little bit about crypto adoption, then DeFi, DAOs, NFTs, cryptocurrencies, a little bit about regulation, and then finally Web3, and I'll give you our conclusions on how we see the space.
We're going to talk about cryptocurrencies. Everything you don't understand about money combined with everything you don't understand about computers.
So that really describes pretty well the state and the understanding of the technology in the public sphere, because unfortunately reality doesn't have an advertising budget. So basically everything you find online or distributed through the media is some form of motivated reasoning. And that's why it's very important that you start with fundamentals. I encourage everybody to read at least the abstract of the Bitcoin white paper. And we're going to break this down a little bit, because even teams that are pitching us for investments keep getting these simple primitives wrong to this day. So Bitcoin tried to introduce a peer-to-peer electronic cash system. So we're going to break down cash. We're going to break down why it is a blockchain. We're going to break down some of the misconceptions. So why is cash a great technology? Cash is great because I can give it to you. I don't have it anymore. You have it, and it finalizes the transaction. And so it's important to understand that if you have been going to a business school, you probably learned the wrong definition of money, as in money is a unit of account, a store of value, and a medium of exchange. That definition was wrong when Jevons wrote this in 1876, and is still wrong today, because it only describes commodity money. Specifically, commodity money at no time in recorded history was actually a relevant technology to mitigate economic activity at scale. So money is simply an agreement between two or more people. If you and I decide that within the context of our interaction, Pokemons are money, then Pokemons are money. If you go into a casino, then poker chips might be money. And if you are otherwise ending up in prison, then maybe cigarette butts become money. So what did Bitcoin introduce? Bitcoin ultimately introduced one particular primitive, and I want to double check real quick. Am I sharing my screen? Yes. Okay, sorry. So Bitcoin really introduced the concept of self-executing code, which is most of the time referred to as smart contracts. It's a little bit misleading, because these contracts aren't really smart. They're, for the most part, they're if-then statements, but they allowed to create two new things in the digital space. The first one that everybody knows is Bitcoin's digital bearer instrument. Unfortunately, it took on the same naming convention as Bitcoin. That's why when we write about the mining reward, we always use the lowercase b for the mining reward itself. And the probably ultimately more important concept that we're going to talk about more later on is that of decentralized autonomous organizations. And so oftentimes you will find articles that claim that Bitcoin solved the Byzantines' general problems. That is actually incorrect. That was already solved by another person that published that particular paper. It was formalized by Robert Shostak in 1978, and then ultimately was solved by Thomas, another person. Anyway, but what it did solve was a particular version of the Byzantines' general problem, which is the problem that occurs in decentralized systems, where you cannot necessarily rely on information coming from other systems participants. In the context of computers, these are other computers that could either be manipulated by an external party, or in the context of being Byzantine fault tolerance, it could be simply that this particular computer is not executing functions as expected. And so there's a lot of unhelpful metaphors in our space, such as wallets and tokens, that we're going to talk about. A helpful metaphor is a metaphor that Nick Szabo introduced back in 1996, and that's a concept that Satoshi built into his paper and into his blockchain. That's why a lot of people think that Nick might actually be Satoshi. And he introduced that concept in a paper published in 1996 and referred to digital vending machines. And so that's a good metaphor, because vending machines work by the way of you having a prerequisite, i.e. a token, a coin in this case. You put it into the vending machine, and you can see the transaction. You don't have to rely on a third party, and it executes exactly what you're seeing. And then Bitcoin was the first smart contract platform, but it turned out to be very hard to program, and that's why Vitalik Buterin came up with Ethereum. So it's a more complex and more potent smart contract platform. So let's talk about some of the most common confusions in our space. So oftentimes people will say we invest in blockchain technology, or we apply blockchain technology, or we research blockchain technology. Blockchain technology is not the same as blockchain. It's a little bit like confusing the internet with internet technology. If I apply the SMTP protocol or the voice over IP protocol, some of the most common internet technologies, that doesn't mean I'm building the internet. And it's important to understand the difference, because also the Bitcoin white paper didn't invent blockchain technology. It existed before. It wasn't called that, and hasn't been called that by the Bitcoin white paper itself. It's a time-stamping mechanism that then hashes these particular transactions into blocks. And there was a paper published that's actually referenced in the second footnote of the Bitcoin white paper that speaks to that particular form of encryption. So blockchain technology is a particular form of encryption. And I keep hearing that blockchains are a particular type of databases. That could not be more wrong. The objective of a blockchain is not to store information, but to store the state of the chain. So these are state machines. So this kind of narrative of a public open ledger is actually an attack vector that you need to mitigate for, and specifically if, when, where solutions create immutable records on a blockchain, it's more likely that they invalidate what we call the required herd immunity of that chain, because all of a sudden you're no longer able to comply with various laws like the right to be forgotten under GDPR. Another confusion that I keep seeing on a daily basis is that people confuse distributed versus decentralized. So the decentralization component is the most important component of blockchain-based solutions, and it's not the same as being distributed. It's the fact that the software is available to anybody, that there is no requirement from anybody to allow me to participate in the blockchain. I can download the software and start running a node, which is not the case in a distributed system. That is just the distribution of these nodes. It's a subset of it. And so that's why DLTs are not blockchains. You will hear otherwise very smart people claiming that DLTs are blockchains. They're very much the opposite of blockchains. And indeed, if you read the Bitcoin white paper, and I assume that people that are claiming that DLTs are blockchains never read the Bitcoin white paper, it actually never mentions a ledger. Then the last point, and that's somewhat contested, but I have my personal opinion on that, and you can weigh in on that if you want to, is there's a consistent narrative that blockchains are protocols. But they are protocols in the sense of business logic. They are not protocol in the network sense. It's important to understand the difference, because it's one thing if I tell you that I saw a jaguar in the parking lot, because that evokes probably a particular picture like this, or I tell you I saw a jaguar in a natural environment, which evokes this particular picture. Then I like to address one common myth in our space, and these are just headlines from the past couple of days that keep claiming that Bitcoin is a contributor to carbon pollution in the air and is wasting energy. That is utter nonsense. You can conflate that very easily. This is a live picture of the Bitcoin blockchain and the various nodes around the world with one argument. The average price that Bitcoin miners paid per kilowatt hours last year was 5 cents. Full stop. So the reason why they paid 5 cents is because nodes go where the energy is the cheapest. Translation: if the energy producer cannot sell his energy that he is producing to another buyer for more, my energy bill is usually 16 cents per kilowatt hours, and that's the cheapest, then he would do so. So Bitcoin mining goes where the energy is indeed the cheapest, which is, you can think of this as extra energy that cannot otherwise be sold to the market for other means. So that's why there's no discussion needed, no measurements needed by Cambridge or anybody else to defeat this argument. It's simply common sense. It's a global network. It has never existed in this way. So proof of work does not add to carbon increase. And now we see intermittently if we have any questions. If not, I'll just keep going.
I think there was one question from Henry. I think I'm going to rephrase that a little bit, Henry. The question was kind of about fraud in the overall Bitcoin area or cryptocurrency areas. What should you do if you get an invitation for some airdrops? Any thoughts on that, or any advice on that?
Well, needless to say, always be careful, and the best thing to do is always see who is the author, right? Who created this particular airdrop, if you're talking about airdrop specifically, but more specifically, who is running this project. Usually this should be easy to find. Usually there should be a GitHub library referenced on the website of that issuer that you should check out, and then check out the profiles of the developers that are involved with the project. If you see that these developers have been part of legitimate firms, have been in the ecosystem for some time, it's way less likely. If there is no one taking responsibility for this particular airdrop, simply stay away. If you cannot identify a team behind this particular project, stay away, don't touch it with a 5'4".
Great, and maybe quickly for the less savvy listeners, what is an airdrop actually?
An airdrop is usually if you commit one of your addresses from one of your wallets to a project, and they will simply send you a token. We actually, one of our teams, we have our own Skunkworks team for Skunkworks development, just did an airdrop over the past couple of days where we airdropped some 200 NFTs for people that whitelisted themselves to identify themselves for a certain project. So you will find those a lot all over the place for various different reasons, and a lot of times they're being curated through something like Discord. So
let's keep going.
All right. So first popular topic, crypto adoption intermittently. To this day, I get emails about crypto adoption, blockchain adoption, cryptocurrency adoption, and DeFi adoption. And this is not even half a sentence from where I'm sitting, because you have to tell me who is adopting something and why. So for what reason, what's the use case, and then how, and then when. Otherwise, you're not actually saying anything, just like you're not saying anything if something is money, because money is an agreement with two people. This is approximately where we are in terms of the overall global adoption. Approximately 5% of the world's internet users today have actually the opportunity to engage with blockchain-based solution, meaning they have a browser, and we usually call these browsers wallets, by the way. So that would be a MetaMask or something else that lets you read data from a blockchain. So you can see that this is rather generous, because even those people that have wallets oftentimes just bought some Bitcoin on a centralized exchange, like the last item here, Coinbase, and simply self-custody their cryptocurrencies in there. So this is, and needless to say, Coinbase is not really a blockchain company. They are blockchain adjacent. They are just selling mining rewards using a database-driven solution. So the point here is we are still very early. However, we are hearing a lot of adoption signals, and a lot of those, coming back to one of the earlier slides, is basically virtue signaling, as in these people think that they are using a blockchain-based solutions, but they're actually using a DLT or otherwise just buying mining rewards like MicroStrategy is on here. And you really have to ask, what is the use case? So some words around decentralized finance, a popular topic this year. So to break this down, DeFi today is about 90 some billion in locked value at the moment, mostly for lending purposes, and they're mostly for digitally native assets. So there's a lot of people that will commit the cryptocurrencies that they don't want to sell into a lending contract to then borrow against it and cash it out for fiat currency in order to facilitate their daily life, because they think that these cryptocurrencies over time will be more valuable than the fiat that they're borrowing. A second use case is decentralized exchanges. We're going to break this down a little more: staking, derivatives, and then very nascent payment applications. This, as well as the other comparison that we'll be making, are somewhat apples to oranges, obviously, for intellectual honesty here. But they give you a good idea of where the decentralized finance space is moving towards. So today you have corporations like Lending Club with 1,000 employees that originated loans of about $4 billion, and they lost money doing that. And you have decentralized applications that have in the neighborhood of 20 employees, and they already create more loan volume, and it took them only 4 years to do so. But as I mentioned earlier, so we had kind of our Netscape moment, which is Coinbase sometimes referred to as the Netscape of the blockchain space, which went public earlier last year at a decent valuation and already has more than 1,200 employees. But now we finally see the emergence of DEXs with high volume. When we first looked at decentralized exchanges, we were very skeptical that these would actually take off. We looked at something like IDEX, which had paltry volumes on a daily basis, but with the evolution of these systems and the support systems like automated market making and liquidity providers, these systems started to ultimately aggregate larger volumes actually than centralized exchanges, custodial exchanges. So our predictions, what we see for the decentralized finance space, there's two developments that we call. One is top-down. So top-down is where an existing player is getting all the licenses and aggregating the existing volume in a space. And then there's the bottom-up development, so like a decentralized exchange that's also aggregating volume, but from a very different cohort, from a very different pool of participants. And both are interesting, and we invest in both. So we're an investor in Figure, which is built on Provenance, which already did the largest home loan securitization since the financial crisis. But then we also invest in decentralized systems as well, and long term they will probably more relevant. Another part of the decentralized finance space is programmable money. We'll break this down a little more later in terms of stablecoin specifically. And what's important to realize here is we started to use the word DeFi, I think specifically because the term fintech was already taken. So my last article for Forbes addressed this particular topic, because if you look at a company like PayPal, so PayPal is really more or less a window dressing solution to the legacy financial system. And the reason why I'm saying this as technology investors, because from our perspective, technology has to be deflationary, as in has to not add another extractive element, and that's exactly what PayPal and other legacy fintech solutions are doing. Versus if you're looking at a decentralized system like in Ethereum, they are not extra extractive, they actually disrupt the legacy fintech solution, and they will disrupt those first before they disrupt other solutions. And now we're going to open it up for quick questions, if there are any, before we move on to the next topic.
I think there was one question which I think might fit in here nicely. What's your take on ICOs for raising funding for startups? I think in the US that's pretty much gone, but maybe you can share your thoughts on it.
Yeah, so ICOs still happen on a daily basis. Sometimes they're called IDOs if it's an initial exchange offering. There's different venues, different platforms, and you're right. Oftentimes they will exclude the United States, which I'm entirely against. But also I have a very different opinion than most when it comes to token in general, because it's the exception to the rule that value will accrue to the token, because more often than not, the token turns out to be an impediment and actually defeats the original purpose of the chain, i.e. that's why when we invested in Ethereum, we invested on the premise that Ether, the mining reward on Ethereum, was the gas and was used as a protective mechanism as to not being able to misuse this kind of world computer. And then now over time the narrative changed. So now, and we'll talk about that, there's this narrative around Ether being Supersound Money. But the larger point there is, you really have to ask yourself, does this project need a token, and will this token accrue value? And from where I'm sitting, that's the exception to the rule. There's this entire misguided narrative around the Fed protocol thesis, which is a little bit like claiming that the value of SIP, which is the voice over IP standard today, accrued to that particular protocol, when indeed it accrued to the application level. So it accrued to applications such as Skype and WhatsApp. So as a tendency, I'd say that tokens will most of the time not accrue value themselves. My favorite topic and the most important topic is this new type of capital formation. Bitcoin, as I mentioned earlier, introduced the first decentralized autonomous organization. And why is this important? It's important because this is the legacy way of aggregating capital. You get very different participants. So you get operators, employees, you get clients, you get suppliers and shareholders. And unfortunately, all of those have very different interests usually, meaning an employee wants to probably receive the highest salary, the client wants to receive the best product, the suppliers want to create the most profit margin for themselves, shareholders just want to see the share price increase, and that creates a lot of friction. Versus in a decentralized autonomous organization, in order to participate, I actually have to be part of that particular blockchain. I have to be part of this particular network and actually provide value to the network. And so that's why the decentralized part that I mentioned and talked about earlier is the most important part, because even though I might be the only person to run a node, worst case, but anybody could run a node, then it would be entirely against my own interest to become untrustworthy and manipulate the chain, because at that point in time the mining reward on my chain would immediately plummet to nothing, because it would be really easy to observe. And so if you compare legacy corporation, I'm using JP Morgan Chase here as my favorite example to pounce on, then you'll see they have 250,000 employees, where there's maybe a dozen Bitcoin developers, core developers. Obviously there are a lot of volunteers contributing to the effort. But Bitcoin has by far higher transaction volumes globally. And again, if you think about this from the context of this whole misguided energy consumption, think about the fact that these 250,000 employees every morning start their car, turn on a computer, and probably every single commercial bank, and specifically the large global commercial banks, more likely actually create more carbon than Bitcoin. And Bitcoin facilitates more transaction, has a higher transaction volume, and is a global technology. So where do we see the opportunities here? So the obvious, from my perspective, loser predictions here are centralized middlemen that don't add a lot of value. So Uber, as one particular example, extracts as much as 20-25% from the activities of the participants in their network, same or similar to Airbnb. We can already see developments around the world where cities start to outlaw Uber in favor of a co-op that aggregates a ride-sharing system, and ultimately we expect that these co-ops will morph into DAOs, and at that point in time there is no extractive for-profit corporation in the middle. And then needless to say, most of these legacy systems then also utilize another middleman in form of a payment system such as Visa or MasterCard, with which extracts another 2 or 3% from the activity that's being facilitated. Ultimately, it's very important that the core of all commercial activity comes down to solving the double coincidence of one's problem that money solves. It's just solving more complex problems associated to that primary commercial problem. Questions at this point in time? If not, we are moving on.
There were two questions online. One was about how do you see blockchain apps for like the shipping industry? What kind of benefits do you see there?
Yeah. Oh, actually, we're going to get to that in detail in later slides.
So I wasn't sure. Okay, that's
Yes.
great. And the other questions we'll keep for the last segment. All right, let's keep going then.
Sounds good. All right. Another favorite topic of the year, non-fungible tokens. So unfortunately, today we are conflating the term non-fungible tokens with digital collectibles. So the first non-fungible token that people might have heard of was Cryptokitties. Actually, we created our own non-fungible tokens before that and have the blockchain entries to prove that we do our own development. The important thing here to understand is two things. When you see these transaction volumes, this is largely wash trading. There's like single apes that sold for $500 million, and this is just one person moving it from one of his addresses to another address to increase the floor price. So be very careful when you see these numbers in aggregate. And unfortunately, even people in our space, in our industry, in the investor space, keep promoting these particular numbers when they should know better that these are really not accurate, and you should always not take them with a gram of salt, but with a couple of shovels of salt. And as you know, even old standing companies like Currencies are now getting into this game, adding to the public confusion that an NFT is some form of digital art, a digital collectible, when the actual use cases, and Thomas was just asking about this for one of the participants, are way more interesting and way more important. So supply chain space. So this is how a supply chain works today in rough strokes. So you got an idea for a product, you might raise some money for that, and then you plant it. So in my example here, we're planting grapes and we are creating wine bottles, and then I'll enter the result of those into a database, juggle these along on the supply chain, and the data and the product moves in the real world, and it moves in the digital world from one data silo to another data silo. As a result, about 47% of all data sitting in supply chains today is false, as in creating externalities where you probably experience this yourself. You're at a store and the clerk tells you, no, it should be here, but it's not here. That's simply the fact that intermittently these information gets entered into a new data silo manually, rather than what we should be doing, which is do the same thing, think about a product, but then start the product by creating a digital clone for it. So this is an NFT on the Ethereum blockchain. Create the product in the real world, and then when the actual product gets handed over in meat space in the physical world, you also at that point in time hand over the NFT and attach new metadata to it. So as a result, what I expect to see in the future is that whenever you buy a physical item, you actually receive the non-fungible token, the NFT, that shows you all the data that this particular item generated before it even was created, who created this NFT and who attached data to it. So you can check provenance and other things just by looking at the record that you own, because you should own the metadata of the physical item that you're buying. And I wrote a longer white paper on the particular implementation of that principle for the supply chain space, specifically for the automotive supply chain space. So right now, if there's a defect in a car, let's say there is a bunch of doors that start failing on one particular model, what's happening is that this car manufacturer is recalling every single car from that model, and that on average results in tens of millions of dollars of losses. However, if and when and where we actually start applying NFT solutions to the physical world, to where I have a QR code or something else that's imprinted in this sheet metal that this particular batch of doors came from, then I'll be able to pinpoint the individual cars that are actually affected by this particular defect. And the obvious first instantiations, and we see a lot of experimentation around that topic, is something like ticketing, something like streaming services, anything where the item is already digitally native. And by and large, the space is limited to digitally native items. That's why we have this unfortunate conflation where people think that digital collectibles are NFTs when they are simply a very tiny example of what this particular blockchain-based paradigm can introduce and will introduce. Questions at this point, Thomas?
I think we can keep going. We will cover some of the questions a little bit later.
All right. So cryptocurrencies, very unfortunate term. That was one of the first articles I wrote for Forbes like 5 years ago, I think, because we started applying this super unfortunate term to every token and every coin out there. And so, as I mentioned before, but it's worth repeating, money is an agreement between two or more parties. Currencies are the systemization of this particular agreement. That's all it is. So your fiat currency, and even the fiat currency in physical form, if you see a banknote, is simply the systemization of this particular agreement, and we might default to it in the nation state context. But obviously, if you go to another country or to a casino, you'll notice, well, currency in this particular circumstance is actually something else. And unfortunately, we have been applying this to all tokens. And a token, and that's worth remembering, every token is simply a standardized smart contract. That's all that is. And so even though I'm showing some of the classifications here, and I'll break some of those down, it's a little bit like trying to catch a falling knife. What I mean by that is that these tokens, so a token is more like an API function to a public blockchain, whereas a coin is actually something different. A coin is the native reward mechanism, and if you go to CoinMarketCap or some of the other sites, you can actually filter for that facility, and you will see the difference right there. But there's this constant effort to try to classify these into commodities and network tokens, stable tokens, governance tokens. There's limited utility in doing that. You really need to look at every token on their own merits, and you need to keep in mind that they're based on underlying open source technology that are still moving forward. They are still being developed on their, still changing their nature. Most people will have heard that the Ethereum blockchain, the largest network out there, will be likely moving from a proof of work to a proof of stake system. So it changes the underlying dynamics. And obviously, I have no idea, if I'm a regulator, if someone is buying Ether the reward mechanism on Ethereum. And by the way, never say you bought Ethereum. You can't buy Ethereum. You can only buy Ether. So the regulator has no idea if someone is buying Ether in order to fuel gas and use it to operate his DApp, his decentralized application, or if this particular individual is buying this for speculative purposes. So again, to try to classify that is kind of a fool's errand. So you really have to look at the predominant use cases, but even there you can't really distinguish. And then, unfortunately, Ethereum, or some in the Ethereum community, started to promote this unfortunate term of Supersound Money. As I mentioned, money is an agreement between two parties. So it's not only vacuous, but it's simply false in that context. It's not money, right? So you can use it as money, but you can use anything as money. It's not saying anything. The important part to understand, though, is where we are. So we started this endeavor here, our first fund, as a family office to prove out our thesis. And so we wanted to focus on the largest parts of global economic activity. And so the largest pieces here are global real estate, bond markets, and so forth. And then you have to probably squint over my shoulder here to see the size of the current quote-unquote cryptocurrency market, which is about 1.7 trillion as of this morning, most of which is still Bitcoin, about 42%, then Ether taking up about 18% of that market cap. And then if you combined the current quote-unquote stable coins like Tether, USDC, Terra, and DAI, which are all very different in nature, then they amount to close to 10% of all the whole crypto market cap at the moment. The important part to understand here, though, again, I will emphasize this over and over again, look at the individual use cases. So let's take Tether as the largest quote-unquote stablecoin out there. You can see the use case of Tether simply by going on CoinMarketCap. The primary use case, 90% of the use cases of Tether, is to speculate against BTC, against the Bitcoin mining reward. That's the use case. And it's a good use case, and you can measure how useful it is because the velocity of Tether, so the number of times a tether turns over in a day is 100% in any given day, and in some days it's 400 to 500%. So we call that a velocity of 1 in a day. As a comparison, the velocity of the US dollar, the government issued fiat currency of the United States, has that velocity in a quarter. So you can see how useful it is, mostly by measuring its velocity within a particular use case. And then a quick word on, I just saw again MIT's paper and talking about viable implementations of central bank digital currencies, and I came around to changing my mind on this particular topic a lot, because what you will find if you bother to read the narrative and or the actual design papers around central bank digital currencies around the world, they are claiming that they are onboarding the unbanked, banking the unbanked, and otherwise facilitate payment functions better and so forth. So what this ignores entirely is the fact that these are not the main problems of government issued fiat currencies. So we do a lot of work, well, a decent amount of work for non-government organizations, and they are specifically non-government organizations that protect dissidents in authoritarian governments that are being persecuted by their own government. And oftentimes that's being done by censorship, and they are specifically by excluding them from the financial system, or if they are not excluded, then they're using it as a surveillance tool against these dissidents. And that's the majority of the world. So the primary problem of government-issued fiat currency is that of surveillance and censorship. And none of the CBDC design papers and none of the communication suggests that CBDCs will do away with that. In that context, CBDCs are useless and shouldn't be used. And specifically, if an authoritarian government, and you probably know which one I'm referring to right now, is implementing this, do not use it. Do not ever use it. The second one that most people think is the more important problem is that of debasement. Needless to say, that there will never be less government-issued fiat currencies. There will always be more, meaning it will always be debased, and the latest debasement by the US government resulted in a catastrophe for everybody who used fiat currencies as a store of value in the certificate of deposits or money market accounts, which is a class of money in the United States that now exceeds the amount of total mortgages. So these people that thought they are storing value, they lost at least 18% of the value that they're storing. So it's basically theft that you can think about here. But the point here being is, the second we had the technology of digital bearer instruments, which Bitcoin introduced, as I showed in my first slide, you can entirely sidestep this debasement. Because what's important to realize is whenever you do a deposit to your bank, what you're actually doing is you're extending an interest-free loan to that bank. So it's legally not a deposit. It actually becomes the property of that bank. Is no longer your property. You have a claim against this bank. And digital money, digital fiat issued currencies always exist in a state of lending. The difference is that you are not the one lending it. The bank is lending it. And so this problem that you don't get to lend it has been solved with digital bearer instruments. So what we currently call, and by we I mean the Federal Reserve System, calls M1, so physical cash, and the larger subset of digital cash, doesn't actually have to exist at all, meaning that I can already, from a technology perspective, move money from one store of value to another store of value without ever being exposed to that primary debasement of consistent money printing. Questions at this point?
There was a question about transaction fees for, cryptocurrencies in general. There was a question about percentages. I think that's kind of hard to answer, but I'll let you take it away.
Yeah, obviously most people will have heard that transaction fees on what people call layer one, so like the Ethereum mainnet, are super high. I was just doing a transaction yesterday for a listing, and just the listing fee was like $180. So it's really high. But the point here being is that's the settlement layer. So there is many attempts to build layer 2 solutions that will do away with most of these transaction fees to where they will become negligible at a not so distant point in the future. And then your interface, so your wallet, your blockchain browser really, will simply use these layer 2 solutions, and everything else will be abstracted away. If it needs to settle, just like Bitcoin Lightning is basically opening up a channel and keeps it open, and the transaction costs on Bitcoin Lightning are negligible. But whenever you settle this Lightning channel, at that point in time, the transaction cost of mainnet incur. But yeah, that's not the point of the layer 1. The layer 1 is the settlement layer, and a lot of people keep focusing on that and confuse it.
I think that was very helpful. And there was another question about what's your take on any government using blockchain for any governmental businesses. I can imagine what you think about it, but what's your take on that?
Well, that interfaces with my next slide, which is crypto regulation. So just let me bring this up. And so I encourage everybody to find at least 10, if not more, of the common fallacies that regulators and governments commit when they're publishing their communication. So on a daily basis, you hear something like crypto regulation, some country is outlawing Bitcoin or Bitcoin mining or something else. And regardless of all the other fallacies, there's a lot of strawman arguments or false equivalencies and so forth. And usually you can find a dozen of those in an article or some propaganda that a government will publish. But the most important one is the last one, equivocation. So that's the point whenever someone is saying that the government is regulating cryptocurrencies, for example, so the SEC is going to start regulating cryptocurrencies, that is simply a lie. Why is it a lie? Because cryptocurrencies and any other technology is regulated already. It's regulated by physics and it's regulated by software code. And governments and government agencies don't get to regulate physics, they don't get to regulate software code. What they do get to regulate is citizens within their jurisdiction. But obviously, if and when and where they would phrase it like that, as in the intellectually honest version of that phrasing would sound something like that. Me, Gary Gensler, I think that citizens under my jurisdictions should not be able to engage with particular technologies in a way that I don't like. And that would get very little buy-in, but that is the honest version of phrasing this particular attempt of quote-unquote regulating crypto. Crypto is regulated, and it will move on. It will move on where it's being fostered, where it's being supported, and even where the government is trying to outlaw that. And the typical example I use for that, the Mexican government for more than a decade outlawed quote-unquote voice over IP. Did people use voice over IP? Of course I used voice over IP, because the alternative was to either not call my relatives in a foreign country where I couldn't afford the metered costs that the nationally sponsored telecom required me to pay. And so the alternative was, okay, I download Skype and I make a free phone call, or I don't call my relative. So the point here being is that with the invention of digital bearer instruments, at this point in time, requiring citizens to continue paying fees to Visa, to continue forcing them to using government-issued fiat currencies, is the equivalent of forcing users to put stamps on emails. It's the exact same thing from a technology perspective. It should not have happened, and we should absolutely push back against this. This is simply better technology. And another word on currencies specifically. If and when and where we allow governments to take a monopoly on the creation of money, well, money is a public good at that point in time, as in it should serve first and foremost the citizens, not specific interest. So all these efforts are motivated reasoning, fueled by K Street. They are fueled by special interest, by the legacy financial service providers. No one is being protected. There is not a single mom and pop, like this typical narrative goes, that has been suffering losses from ICOs, because it was actually very hard to partake in those. And by the way, if they wanted to do so, why shouldn't they be able to do so, right? So it would be more useful to outlaw things such as the lottery, the state-sponsored lottery, which is way worse and incurs way more damages, or outlaw gambling for that matter. We are not doing that. People should be able to gamble on Dogecoin if they want to. I don't recommend it, but they should be able to do so if they are adults. Again, this is my personal opinion, but simply from a technology perspective, digital bearer instruments are simply better technology for the transfer of value, just like voice over IP is a better technology, and we're using it right now for free for me to communicate with you all. We don't have a state-sponsored telecommunications agency anymore. By the way, another anecdote, and then I stopped talking about this particular topic, is that when we invented fax machines early on, the post office, the nationally sponsored post office, lobbied hard that these faxes could only be printed at a post office. So it's utter nonsense what's happening right now, and everybody needs to always rephrase the propaganda that you see on a daily basis in the media, where there's claims being made that crypto is being regulated. What's being regulated is citizens. Thomas, do we have questions?
Oh, where are we? How far along are we? There's tons of questions, but I want to make sure we are kind of like...
Yeah, we're getting to the most important topic that people don't talk about much and or misunderstand, which is the topic of Web3. Before we get to a conclusion.
There was one question which I thought might be interesting for the entire audience. Maybe we can cover that quickly. How worried are you about quantum computers potentially impacting the safety of blockchain?
Not at all. Listen to the answer that Vitalik Buterin gives on that particular topic. So before we have quantum computing, we have quantum encryption.
All right, very good. And I think in general, let's go to Web 3.0. I think that's your last segment.
Yes,
we will stay on. There's lots of open questions which we will stay on, answer after the talk. But let's kind of finish up so we kind of somewhat stay within the time frame.
Yes, so this is the most important topic because it puts blockchain into perspective, and it's important to understand this. So here's the big picture. So commercial activity at scale, once we started to industrialize, so remember, up until not so long ago, most US citizens were busy toiling in the fields and making a living as farmers in one way or the other. And only after the industrialization, we started to develop large-scale economies that changed this particular paradigm. And so initially, we used mainly paper-based technologies to document this and facilitate this commercial activity. So the pre-digital era, which should be noted that databases were only invented in the 1960s, and so they are specifically COBOL, which today is still part of some banks and government agencies of their database code. But then we made the rather unfortunate decision to attach network technologies to these databases. And with that, we saw the emergence of very powerful organizations today, centralized organizations such as Facebook, Amazon, PayPal, with all their externalities that we're going to talk about in a little while. The important thing to understand is that decentralized software solutions, blockchains being the most popular one, but there's other ones such as directed acyclic graphs, but blockchains solve the problems that databases introduced. They solve the copy and paste problem. So if you simply embrace the fact that the only virtue of blockchain-based solutions is to hand over control over a set of bytes from A to be and nothing else, then you know more now than 90% of people that are trying to develop solutions on top of it. So the point there being is databases are a very insecure technology. Databases cannot be protected. The externalities from database-driven solutions are tremendous. Actually, cybercrime, which is mostly associated to two things. A, social engineering, as in someone is being hacked, quote unquote, as in the person is answering a phishing email and so forth, is the main reason that people are getting into databases. But then because of the permissions that this particular individual might have, they all of a sudden have access to all the records in this particular database. As an externality, cybercrime is a $6 trillion industry as of last year, which is larger than the entire GDP of Germany, by the way. There's only two economies that are larger, which is the United States and China. All other GDPs are smaller than the externalities of database-driven solutions. And that is actually the main application of decentralized software solutions. So in principle, that is what Web3 is solving for, except that we are still missing most of the primitives. So this is likely the most important slide that you need to embrace. So as I mentioned in one of the early slides, blockchains are indeed not protocols in the network stack. They're making use of protocols. They're making use of TCP/IP, HTTPS, and so forth. But then we need a lot of other technologies that are being built right now. They're in the infancies that do the kind of what I call on and offboarding of legacy systems to the decentralized world. So we need to have decentralized addressing. It's very nascent. I'm a big fan of something like FIO, which is an interoperability program of what we call wallets, so of browsers really. And that solves the addressing problem, because right now if you're using a company that I put on the top here like OpenSea, OpenSea is entirely dependent on OpenSea.com working, and that particular naming system is run by a for-profit company that if they get a subpoena, they will just shut it down. And aside from that, OpenSea is not decentralized in many other ways. So it's not really a dApp at this point in time, because we are missing all the layers that I'm showing here. As a disclaimer, a lot of these companies are part of our portfolio today. I already mentioned the cost of cybercrime, so I'm not going to go into that. Maybe as a side note, so the average cost to a US company last year was in excess of $8 million per incident. There's an incident almost every hour. And now we're talking about a company that is bothersome for two things. There has been this claim that I keep repeating that's slightly false but directionally accurate. Every Google search takes a lot of energy. As in, at some point in time, the claim was made that one Google search takes as much energy as powering a light bulb for an hour. That's probably incorrect unless you actually aggregate the entire search. What I mean by that is that usually you do about a dozen searches before you derive at the particular result. And that's because, pointing out the earlier DAO example, you are not a Google client, you're a Google product. You are, more importantly, a non-player character in the game called Google. If you go online and Google, you are not on the internet. You are on a platform called Google. And Google's business model, and every for-profit company has one algorithm that's adhering to, which is increasing shareholder value. Google's business model hasn't been advertising for a decade, and Facebook's business model hasn't been advertising for a decade. What these companies are selling is social engineering as a service, because obviously they don't care why you're buying the spot. They don't care if you're selling some product or service, or simply are trying to influence the users of this particular platform not to do something, i.e. not vote. So the most important aspect to understand is what we're doing right now. We are building the internet for the first time. That's why I don't really like to use the term Web3, because it's yet another marketing term, such as the term fintech or Web 2.0. Because we are building Web 1.0 right now. What do I mean by that? Right now, network topology looks at every user as in the same way it would look at an IoT device, something like a weather station. It will observe the data that you're producing, it will copy it, it will distribute it, it will refactor it and make it available to the platforms that you are engaging with. There's 4,000 to 5,000 databases with 4,000 to 5,000 records about you. These particular platforms know more about you than you know about yourself. They can socially engineer you and the society at large into whatever they think is benefiting their particular result. So in order to reverse this paradigm, we have a lot of laws that already are protecting human agency. But what we haven't built is the technology to enforce these laws. So the way I phrase this metaphorically is you should be in control, possession of your digital dust, your digital footprint at all time. And you don't have the right to be forgotten in the digital sense, which is naive to request this. You have the unalienable right not to be observed, because simple observance will change your behavior, and authoritarian states obviously know that and are using this technology in this particular way. So if and when we actually create what we call wallets now, which are really browser solutions, in a way that you can protect all your digital data, then you will only stream access to a subset of this data, and only they are usually kind of what I call a green check mark if it serves your own needs. But everything else you will basically opt out of. I call it the opt out of all my data function, kind of like you opt out of the do not call, or opt into the do not call list, and opt out of commercial interest being able to reach you. And that's why we're building all these primitives. And there's cracks, if you pay attention to it, across all of the Web3, all of the what we call Web2 solutions today. So Facebook already paid a $5 billion settlement to the Federal Trade Commission for violating their assent decree, and again using data in a way that they were not allowed to under that decree. But they also paid a $550 million settlement towards the state of Illinois for violating the biometric laws of citizens of Illinois. There's 4 states passing the same law right now. And there's only so many companies that can withstand the $550 million more than once or pay it at all and still be alive. So there's a lot of efforts right now, and they're usually formulated under some kind of unfortunate terms. I'm the co-chair of the Banking and Finance at the Decentralized Identity Foundation. I personally don't actually use that word identity in this context, because identity requires consciousness. What we are talking about here is legal technology. From a legal technology, we are talking about agency and attribution. So we're building the agency and attribution layer of the web right now. Questions here before I summarize our thesis?
I think we are like way behind schedule, so we'll put all the questions. We put all the questions at the end. Chris and I will stay on. But yeah, why don't you take it away with the summary?
Sure. So our macro thesis is really simple. So blockchains in Web3, and as I showed, blockchains are a part of the Web3 stack, really fundamentally disrupt how value is created, how it's transferred, how it's stored, and how it's governed. And as investors in technology, investment is all about timing. So we focus on the timing of the technology. So you couldn't have invested in a YouTube competitor before, and there were hundreds of those. Before there was broadband around. So you need to understand the timing of the technology. So the most opportunistic place, and that's what our first fund proved out by creating 3 unicorns, is the focus on disruptive finance solutions. So what I showed you guys earlier, programmable money, lending solutions, payments, remittance. Think about it this way: the payment industry today, or last year, was about 2.7 trillion. That's an industry that doesn't have to exist at all. As I mentioned, it's like putting a stamp on an email. And then we focus on investments in applications that develop and utilize Web3 primitives. That's the stuff that I showed you in that stack earlier. So includes projects such as the Graph, which is a blockchain indexing system, and so forth. And I have been publishing these thoughts for quite some time. You'll find a dozen or so articles on Forbes over the past couple of years. That should be easy to find if you just put in my last name plus Forbes into your browser. And we'll be publishing a concise book on the topic of streaming money later this year. And now we can go to FAQs.